Hello friends. My name is Krishna and I am a virtual tutor in professional accounting. This is the first lecture on a series of lectures relating to working capital management. In this session, we shall learn about the basics of working capital management. So, what is working capital? In simple terms, working capital is the fund that is available to meet the day-to-day operations of a business. It is the excess of current assets of a company over current liabilities. Now the question is that, what includes current assets and current liabilities of a company? Current assets generally include inventory, accounts receivables, and cash. Whereas current liabilities generally include short-term bank loans and trade payables. So, working capital formula is equal to inventory, receivables, and cash, less trade payables and short-term bank loans. So, why should a company invest in working capital? A company earns profit by investing in non-current assets. And an investment in working capital doesn't generally earn profits for the company. However, a company needs enough funds to ensure that the day-to-day business operations are managed effectively. For example, a company needs working capital in the following cases. 1. A company needs cash balance to settle its utility bills. 2. A company needs to invest in inventory to ensure that it has sufficient stock to meet the customer needs. 3. A company also needs to provide credit to its customers as per the industry requirement, which in turn needs investment. Now, what is the ideal working capital investment? Generally, if the current assets are above current liabilities, it is considered to be a positive sign. However, as pointed out earlier, working capital doesn't earn profits directly for the company. Excessive investment in working capital means that the company is misusing its funds, which could have been invested in non-current assets, to generate profits for the company. So, the company should be very careful while investing in working capital. In general, there is no standard investment in working capital. Instead, the company may adopt the industry standards and make necessary changes by incorporating the specific requirements of the company. Now, how should a company finance working capital? It is a general belief that non-current assets should be funded through long-term finance and working capital through short-term finance. However, this is not often true. Long-term finance normally shall be costly, as it is taken for a fixed long-term period. And the interest needs to be paid throughout the long-term period, even if the company doesn't require the finance at any point of time. However, on the other hand, short-term finance is risky, as it may normally be repayable on demand. A general view is that the average working capital can be funded through long-term finance, and any temporary excess working capital needs to be financed through short-term finance. So, how can a company improve its working capital management? A company that has working capital issues may improve its working capital position by 1. Implementing an effective inventory management process. 2. Setting up an adequate collection system. 3. Obtaining better payment terms from suppliers. So friends, that's the end of this session. In the next sessions, we shall go further into the details of working capital management and the related ratio calculations. Till then, bye-bye.